Have you ever noticed how rapidly market conditions can shift, sometimes in the blink of an eye, and wondered how you can possibly keep your trading strategy on track? It can feel like trying to hit a moving target, especially in fast-paced environments. Volatile market conditions significantly alter trading plans by demanding increased flexibility, stricter risk management adjustments, and a reevaluation of typical entry and exit strategies. The core changes revolve around adapting to unpredictable price swings and managing the amplified potential for both gains and losses. The primary reason volatility necessitates changes is due to its direct impact on market behavior and microstructure. High volatility means that price movements are larger and faster, often leading to wider bid-ask spreads and increased slippage, which is the difference between the expected price of a trade and the price at which the trade is actually executed. This environment can invalidate technical analysis setups much quicker than in calmer periods, as support and resistance levels may be breached with greater force. Furthermore, sudden shifts can trigger stop losses prematurely or make it harder to execute trades at desired price points, fundamentally changing the risk-reward profile of any given setup. To practically adapt, traders should first consider reducing their position sizes. By deploying less capital per trade, the financial impact of an unfavorable swing is minimized. Simultaneously, reevaluate stop-loss placements. While some traders may advocate for tighter stops to reduce risk, others might argue for wider stops to avoid being stopped out by random noise, balancing this against increased risk per trade. It is crucial to focus on higher conviction trade setups and potentially shorten trade durations, shifting towards strategies that capitalize on quick, sharp movements rather than longer-term trends. An insightful detail to consider is the concept of volatility regimes. Markets often cycle between periods of low and high volatility. Understanding which regime you are in allows for proactive adjustment rather than reactive scrambling. For example, during high volatility, implied volatility on options or derivatives tends to increase, reflecting market participants' expectations of larger future price swings. This understanding can help traders select appropriate strategies like straddles or strangles in some markets, or simply confirm the need for caution and reduced exposure in others. Ultimately, navigating volatile markets effectively boils down to proactive adaptation and disciplined risk management. By understanding why volatility impacts your trades, you can implement practical adjustments to position sizing and strategy, ensuring you stay resilient and continue to identify opportunities even when the market feels like a roller coaster.